Fund Supermart, your online gateway to unit trusts.
Hi Amanda. Tell us more about the key unique point of Legg Mason Western Asset Global Multi-Strategy.
This strategy is actually one of our oldest standing strategies. It's actually coming up to its 20-year anniversary as a strategy. And it's really a total return, unconstrained, strategic allocation to fixed income globally. So what we do, based on our global fixed income team, we allocate to the sectors within fixed income, whether it be high yield, emerging markets, investment grade, or sovereigns, developed market sovereigns. We allocate to those areas of which we think have the strongest strategic value. We are slowly, strategically rotating through those sectors, and over the long term should be able to generate you strong income returns as well as total return over an investment cycle.
Why is it a good time to invest in the fund?
Well, when you think of it theoretically, an unconstrained fixed income global portfolio is able to allocate globally wherever we think there is value. And it's very rare that there is nothing globally that adds value. Now, having said that, there is always an advantage when there is yield in the world and credit spreads are actually more wide, or you can get more income from credit. Now, we think we're in one of those environments now. In fact, credit has been one of the strongest performers year to date. Now, do we think that that's going to continue? To some extent, yes, we do. So we still are positioning the portfolio in credit and, in some cases, emerging markets. So there's no one perfect time to invest in an unconstrained fixed income portfolio. Having active interest rate management is important to be able to go through different cycles and add value. And that's certainly something that the global multi-strategy portfolio can do.
What are some of the key themes in the fund?
The theme at the moment, and certainly since where we saw the lows of the market on the 11th of February, is that credit particularly, and now emerging markets, offers exceptional value. If you look at how the markets were pricing in things like credit, things like at emerging markets at the beginning of 2016, it was really pricing in almost a recessionary type of environment, in some cases more than a recession. So we felt that globally is the best place to position the assets of the portfolio. And that is why we have a reasonably high allocation to high yield, around 25% of the portfolio, similar allocation to investment grade, and of course emerging markets. Now you may ask, is that over? We've had this exceptional rally. The strategy is up roughly 12% year to date. And we think it is time to take some profits in the credit market. And we are doing that in single names that have rallied exceptionally strongly over recent periods. But we don't think that run is over. So we still think credit is a good place to actually hold the investments at this point. Emerging markets, we feel will do well, particularly in an environment where global growth is improving, and that is our forecast for the next 12 months or so. So if global growth is improving, currencies are stabilizing, and emerging market monetary policy can actually start to cut rates rather than actually maintain or increase rates based on increased inflation, we think that's a really good backdrop for emerging markets. So the themes are at the moment is spread or credit still has value. It's prudent to take some profit now. Emerging markets have a long way to go insofar as generating returns. So that's where we are focused. Now, having said that, there is risk, particularly in Europe, when it comes to interest rate exposure. We are going through a period of which we have negative yields in a lot of European countries, as well as Japan, and that's something that every fixed income manager needs to be mindful of. So if you look at where we're taking our core government risk at the moment, we much prefer the US rather than Europe. We use US Treasuries as a way to manage volatility, and we're not suggesting that the current period is going to be without volatility. There's always volatility, but US Treasuries are the best way to manage that. So not in European core governments, in US Treasuries, and still value in credit and emerging markets. And we certainly think that's the best way to capture the global fixed income markets over the next 12 months and beyond.
Thank you.